Welcome to Breaking News to Trading Moves. Today we're looking at a key update from CoreWeave. It really gives us a good view into the AI infrastructure market right now, all the pressures and dependencies.
Yeah, that's a good way to put it. CoreWeave, that's ticker CRWV, they recently adjusted their financial guidance for 2025. Now, they actually beat Q3 revenue estimates, brought in $1.36 billion, which is strong.
Okay.
But they did have to trim the guidance for the full year, 2025, lowered it to between $5.05 billion and $5.15 billion.
Right, that's a bit of a cutback, especially for a company that's, all about growth.
Yeah.
The market noticed, too.
Oh, yeah.
CoreWeave shares dropped, 9% to 11% pretty much right after. And the reason they gave was a capacity delay, something about a partner.
Exactly, a delay at a partner data center developer. But, and this is important for you to understand, they stressed it wasn't about demand drying up. No, the customer backlog is still huge. We're talking $55.6 billion. That's massive. The problem isn't people wanting the AI capacity. It's actually building the physical data centers fast enough, getting the power, the space.
Ah, okay, so it's a construction bottleneck. Management actually called it an industry-wide thing, right?
They did, an industry-wide build bottleneck.
Okay, so that's what we want to explore. Let's look beyond just CoreWeave. If one major player hits a snag because construction is lagging, well, who actually benefits when capacity gets tight like this? And on the flip side, which companies are feeling the pinch from these kinds of scheduling risks? Let's maybe start with the winners, the ones who might gain something here.
Sounds good. So when you have tight near-term supply of actual data center space, it tends to push up the pricing power for certain suppliers upstream, the companies selling the stuff that goes inside the data centers, regardless of exactly when the building gets finished.
Right. So first up would be AI chips and high-speed networking gear, like the really specialized GPUs and that super fast 400G, 800G networking equipment.
Precisely. Demand for that stuff is already, frankly, way ahead of supply. Think about training these huge AI models. It takes incredible computing power. So if a data center build gets delayed by, say, 3 months, it doesn't mean the order for thousands of GPUs gets canceled. It just gets pushed back a bit.
Okay.
And because supply is already so tight for these components, the manufacturers can keep their prices strong, keep favorable terms.
So companies like NVIDIA, ticker NVDA, Arista Networks, ANET, and Broadcom, AVGO. They're somewhat insulated.
Yeah, largely. Their main constraint is usually their own manufacturing capacity, making the chips, packaging them, not necessarily the construction timeline of one specific customer's building.
Got it. Okay, who else benefits?
Well, the second group, and this is maybe more immediate, are the big hyperscale cloud platforms.
Ah, okay. So if I'm a startup, and my plan was to use CoreWeave for my AI training, but now that capacity is delayed, where do I go?
You probably go to the giants, right? Amazon, AMZN, Microsoft, MSFT, or Google Cloud, GOOGL. When these specialized providers hit a wall, even temporarily, some of that workload spills over to the hyperscalers. They already have huge global footprints, lots of capacity redundancy across regions.
Wait, though, if CoreWeave's delay points to an industry bottleneck in construction, wouldn't the hyperscalers face the same issues building their own data centers? Are they immune?
Not immune, no, but they have advantages. Scale is one. They just have vast amounts of existing capacity already built out, which acts like a buffer. And maybe more importantly, they've been doing these massive builds for like a decade. They often have power contracts locked in, land secured, relationships with utilities, things that newer or smaller players might struggle to get quickly.
Okay, so they have the existing infrastructure to absorb the immediate demand, even if their own future expansion might also face some of these construction hurdles down the line.
Exactly. They catch the immediate overflow.
Makes sense.
Yeah.
And the third group on the winning side, you mentioned scale data center REITs, real estate investment trusts, like Equinix, EQIX, and Digital Realty, DLR.
Yes. This is key, because often the real bottleneck in data center construction isn't just the physical building, the concrete and steel. It's the power.
Getting enough electricity.
Huge amounts. We're talking multi-megawatt capacity. Getting the permits, the utility agreements, getting transmission lines built. That can take years. It's a major hurdle.
So when a company relying on a partner hits a delay, It sort of highlights the value of these big REITs who already own the land, have the power sorted, maybe even have buildings ready or nearly ready.
Precisely. They have these robust development pipelines already in motion. When supply across the market gets tight because of these build-out issues, these established REITs can often command better pricing, higher rents, better lease terms.
Because customers need the space now and these guys have it or are closest to having it, their ability to execute on building becomes a real advantage. Okay, so we've covered the potential beneficiaries. Chip and networking guys like NVIDIA, the big cloud platforms like Amazon and Microsoft, and the data center REITs like Equinix. Now let's flip it. Who's feeling the pressure when capacity gets constrained and schedules slip?
Well, the most direct impact, Category 1, is obviously the AI specialist clouds themselves, the ones who depend heavily on third-party developers for their expansion. They directly inherit that schedule risk.
Right. So CoreWeave, CRWV is the prime example here. The guidance cut, the stock drop, it's a direct result of this capacity delay.
Yes. And you could also argue there's some exposure for companies like, say, Snowflake, ticker SNOW. Now, they aren't a cloud provider in the same way, but their growth, especially in AI workloads, depends on their customers having the infrastructure ready to actually deploy and run those big data models.
So if Snowflake's customers are planning massive AI projects, but the underlying data center capacity they need gets delayed, it could slow down Snowflake's own adoption curve or usage growth.
Potentially, yeah. It introduces sensitivity to customer timing and infrastructure readiness.
Okay. What's the next category under pressure?
Category 2 would be the EPC firms. That's engineering, procurement, and construction companies. The ones actually building these complex data centers.
Now, you might think construction companies would just be busy, right? Why is a delay bad for them if the project isn't canceled?
It's about revenue recognition and cash flow predictability. When a developer hits delays, it creates risk for the builders, like Jacobs Solutions, ticker J, or Fluor, ticker FLR.
Yeah.
They might complete a huge chunk of work, maybe build a massive cooling system or install the electrical infrastructure.
Right.
But they often can't officially recognize that revenue, basically can't log the sale on their books until the entire site section is finished, handed over, and accepted by the client.
Okay. So if they finish their part in Q4, but the overall site isn't ready until Q1 because of some other delay, they can't book that Q4 revenue. It slides into the next quarter.
Exactly. It's like building a custom machine for a factory. You can't really bill for it until the factory floor is ready to take delivery. This kind of postponement creates volatility in their quarterly results, makes forecasting harder, even if the underlying project is still solid.
Got it. That makes the financial impact clearer. Okay, what's the final group feeling the effects?
The last category is the AI server OEM's original equipment manufacturers. These are the companies assembling the specialized server racks packed with GPUs. Think Supermicrocomputer, ticker SMCI, or Hewlett-Packard Enterprise, HPE.
Okay, why are they affected? Their servers might be built and ready to go.
They face what you could call delivery cadence risk. These are complex, very expensive racks of equipment. They need a specific, prepared, powered-up physical location to deliver and install them.
So if the data center building itself or just the power hookup is delayed,
then those finished server racks just sit there, maybe in the OEM's warehouse, maybe at a staging facility. They can't deliver, they can't install, they can't complete the final step.
even if the servers themselves are ready.
Right. The physical site has to be ready to accept them. Certified, powered, secure. If the doors aren't ready to open, metaphorically speaking, the servers wait. This creates near-term uncertainty in their order fulfillment timing. It can lead to inventory carrying costs and maybe even changes in customer needs if the delays drag on. Their production needs to sync up with site readiness.
Okay, so looking back, using this CoreWeave news as a lens, we've traced the effects right through the AI supply chain. From chip makers like NVIDIA, who are somewhat buffered by their own supply limits, to the hyperscalers who might catch spillover, the REITs who benefit from tight supply, and then down to the specialist clouds like CoreWeave, the construction firms like Jacobs, and finally the server OEMs like Supermicro, who feel the direct impact of site delays.
Yeah, I think the main takeaway here is how interconnected this whole ecosystem is. And maybe, more pointedly, that the bottleneck in the AI race seems to be shifting. It's less about just silicon availability now getting the chips, and maybe more about the physical world constraints, building these huge, power-hungry facilities quickly enough.
Bricks and mortar and power lines.
Essentially, yes. A delay for one company like CoreWeave really highlights these dependencies across the board.
And CoreWeave explicitly blamed an industry-wide build bottleneck. So here's something for you, the listener, to think about. If the main thing holding back faster AI deployment right now is actually construction and utility infrastructure things that notoriously take a long time to plan and build, what does that mean for the overall pace of AI adoption we can realistically expect over, say, the next couple of years?
It's a really important question to consider.
Definitely something to chew on. Please remember, the information presented here is not financial advice or a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the material reviewed.